When do valuations start to matter? And we talked about this on Market Call earlier this week, Michael, but I'm going to rattle off a few things. And everything I'm about to say is either in the 99th percentile or the 100% percentile. PE ratio, the CAPE ratio, which we talk about all the time, which by the way, I think is trading about 38 or so. The median is 17. I think the top ticked at 44. Dividend yield, price to sales, price to book, something called the Q ratio. I think that's Tobin's Q. That's the market value divided by the book value of a company. That's in the 98th percentile. The Buffett indicator we talk about all the time. Average household equity allocation in the S&P 500 divided by M2 money supply. All of those things, either 98th, 99th, or 100 percentile, meaning that they are all historically expensive. That sort of juxtaposes January of 2009 when all the things that I just talked about were either in the 1 or 2 percentile of the other end of the spectrum. So again, not timing indicators, but all of these things have been flashing red now for a while.
Yeah. Well, it'll matter when it matters, as you like to say. I mean, long term, it matters right now. So if you're a person who's looking over a 10-year time horizon, it's pretty obvious that, a lot of these assets are going to be underperformers. I mean, if you pay a high price over a 7 to 10 year period, it's almost guaranteed you're not going to make a very good return. There are two things that we also, back in May, that we kind of figured out, and maybe late, but if the Fed is cutting rates, okay, and earnings are not going down, it's very difficult for the multiples to actually come down, even if they're already elevated. So as long as the Fed isn't raising rates, which could happen at some point later this year, right now that's not our call. Our call is they're going to cut 1 or 2 more times this year. If they're cutting rates, and as long as forward estimates are still moving up, it's very unlikely that multiples are going to come down more than 3, 4, 5%, like in a tactical move. If we were to get a shock from two ways, I think there's 2 potential shocks here. One is there's an exogenous shock that where growth rates come down. Okay, so then earnings don't go up anymore. Then that's, it's not a recession, but it's an earnings recession. The other one would be what we're starting to see a little bit late last year, is that rates kind of get out of control at the back end. So if you recall back in the fall, right, or actually last summer, there was concern around a hard landing. Stocks really sold off hard, bonds rallied.
How silly. And that was a legitimate concern. There was going to be a hard landing. Well, remember there was going to be a no landing too, right?
Last year we had no landings, hard landing and soft landing all throughout the year. But my point is we priced that recession out. But then remember the Fed got nervous too. The Fed was worried a little bit and they cut 50 basis points and then they cut another 2 times.
Can we talk about that for a second? Because you were here September 12th. Yeah. That happened September 18th. Guy literally had... you kind of went nuts a little bit on fast money that day. Do you remember? I don't mean
because Jeremy Siegel made comment. I mean, it was all around. I think that was around August 5th.
You were so right. You brought it to him. The guy was like screaming. His hair was on fire. They needed to emergency, right? And literally, guy, he didn't go nuts. He was like looked at the camera, and it was not pretty. It was interesting. Jeremy Siegel.
No, but yes. So that was August 5th, and then September. Obviously, But to your point about interest rates, I mean, I think it's fascinating that since the Fed cut, we saw 10-year yields go from 3.6, a little lower than 3.6. We got up to 4.8%. I mean, that's a pretty dramatic move in a very short period of time.
Well, first of all, it's unprecedented. Okay, this is where I was going with this, is that the Fed, I think, cut perhaps inadvertently, and they signaled probably too an aggressive of a move. And the back end of the bond market hated it, right? Just they're like, wait a minute. And so this 100 basis point cut at the front end was married with a 125 basis point move up at the back end. And it's all term premium. A lot of it's term premium. So that is like toxic for stocks. And we had identified this correctly, that we were fine as long as it didn't get above 4.5. So we're now above 4.5. So I'm answering your question in a long roundabout way. I think if rates continue to move higher at the back end, Guy, multiples will come down more than what people are expecting.
Okay, so let's play that out. So where is it when the market obviously cared on December 18th, December 27th, but that cared for a day. When does it care in earnest? Like, is there a level? I mean, I thought it'd be 4.5%. That proved to be wrong. We got up to 4.8. Nobody seemed to care. Is it 5% because it's just a round number, or is there math behind this?
Well, no. 4.5 did matter. I mean, we did see a pretty healthy correction in a lot of stocks, and it was fairly sharp. Now remember, the S&P, if you're looking at the S&P, that's the highest quality bucket. So it corrected the least.
Mm-hmm.
The Russell was down 10 or 12%. A lot of lower quality stocks were down 20 or 30%, and there was no change in their earnings outlook. So I would disagree. I think at 4.5 the market did care, but then we got that quote unquote softer than expected CPI number, and then we had to kind of reprice that in. And then we had the inauguration, which is, I think, a fairly euphoric event. So the combination of those two is just sort of, I think, fooled us that we're back here, but we haven't resolved this rate risk. Now, I don't know where rates are going, but if the back end were to go towards 5, absolutely, I'd be stunned if multiples don't come in 5 or 10% kind of across the board. So what's going to cause a move to 5%?
Well,
that's the question.
Well, that's was my question to you. So I think it's a number of things, but I think the biggest factor is the number of issuances that are coming out in the beginning of this, which has just started. I mean, the Treasury issuances this year are probably historic, and they played sort of the short end with Janet Yellen. They can't play that game in perpetuity.
That's right. So I think this is an interesting transition to the new Treasury Secretary. Scott Bessent's probably going to get confirmed. He's been vocal about what you just said, that we can't fund at the front end forever. The question is Scott going to address, is he going to deal with that immediately, or is he going to do it over a longer course of time? Because, he's a smart person. He doesn't want to shock the bond market either and kind of lose control. But it is there, right? The bond market it knows about it. Eventually, we're going to have to extend maturities, and the question is timing. So that's one potential risk. The other one is that inflation does come back, right? I mean, why not? We have a lot of animal spirits going now. There's a lot of activity happening. There's some higher velocity things happening because of the administration and some of the policy changes, maybe more lending growth. If that happens, maybe the Fed has to raise rates again. That's definitely something that bond investors are thinking about. I think there's a 20 to 25% chance now priced in to the front end that could happen. So that would be another reason why the back end might move out.
Well, and sorry to but the CRB index, which is different than the GSCI, the Goldman Sachs Commodity Index is heavy energy. But the CRB index, as we're sitting here, is at levels we haven't seen in 15 years. Obviously, a much different, it's comprised from different things. It's more the soft commodities and what have you. But if you're just looking at that, by definition, inflation is back.
Yeah, but inflation is not to the target, okay? And I don't know many folks who follow this data closely, including our own, that think we're going to get to 2% anytime soon, right? We may get there by end of the year. Even the Fed themselves are targeting, that we're not going to get there until end of the year, early next year, assuming everything else kind of plays out the way they think it's going to play out. So inflation's percolating. And I just want to maybe pivot a little bit here. Now let's talk about Trump 2 versus Trump 1. So when Trump got elected the first time, there was probably nobody more bullish than me because it was the perfect kind of president and policy change for that moment, meaning we were coming off a period of secular stagnation. We had a big output gap. There was scope for stimulus. Mm-hmm. Today, we don't have that, right? The output gap is actually is negative, and we don't have supply in labor. We don't have supply in a lot of different things. And so if you do reflationary type policies, getting animal spirits going, the bond market is going to be the gating factor potentially. Now, I do think the administration understands this. Okay, so the question is, are they going to roll out maybe some growth in all the negative stuff first, like tariffs, like dealing with the border, which is growth negative because you have less immigration, less people to work, less people to spend money. Does he do that stuff up front, kind of slow things down in a way where then they can do the more pro-growth stuff later? These are the questions we don't know the answer to, but this is what I'm very kind of focused on at the moment, which is it's not going to be a repeat of 2017, which, by the way, was the highest Sharpe ratio year for global equities. Because once again, the policy changes at that time were received very well by the global macro variables. And this time it's a little bit different. So I think it's going to be a messy first half. And if some of this stuff gets pulled off, though, I think the second half could be quite good. And that's when you will get the broadening out, because that's when rates can come down. If they can deal with this stuff the way I think they can, then actually the term premium will come down. They'll find a way to fund the government that the bond market can get comfortable with, and they can actually get rates lower.
Are we at peak margins? We saw Procter & Gamble report earlier this week, and they're talking about, passing costs, through less and less than they had been over the last few years. And again, that is, a global company that has a lot of exposure overseas, but the earnings were fine. And so what does it mean if we get to a period of kind of peak margins for the S&P after these companies during an inflationary period were able to kind of have some pricing power?
Yeah, that's why I think the first half is going to be a little choppier. It's going to be harder because expectations are higher, multiples are still high. The Fed's probably not going to be able to cut as much as people were thinking 2 or 3 months ago. Back end rates are sticky to the upside. And so now it really does come down to there are going to be individual securities and stocks that can surprise to the upside. Even within the magnificent 20, call it, right? We're seeing a dispersion. I mean, we're seeing some continued winners and we're seeing some that have really underperformed since the summertime. So, probably more of that.